Friends, thank you for being here today. What if I told you that the people who print the money are now firing their own staff to save money? The Bank of Canada just announced it will cut 225 employees. That is 10% of its entire workforce, gone by June 2026. This is not a routine downsizing. This is not a management reshuffle. When the institution that controls the monetary scaffolding of an entire nation starts counting pennies, something fundamental has broken. Think about what that means for a moment. The central bank, the lender of last resort, the entity that can create currency with a keystroke, they are now trimming their budget like a struggling household clipping coupons. And this is happening inside a broader federal austerity drive that will vaporize 40,000 public sector jobs by 2028. The people who manage the architecture of money itself are preparing for a leaner, harsher, more volatile future. And if they are worried about their own survival, friends, why aren't you? This is a structural fault line, not a temporary adjustment. Let me give you the scale of what we are witnessing. Canada's federal government is pushing for budget reductions of 7.5 to 15% across departments and crown corporations. The Bank of Canada alone is targeting a 15% budget cut between 2026 and 2028. Staff, operations, everything. They have already frozen vacant positions. They have offered early retirement packages. They have trimmed non-salary budgets to the bone. And still, the cuts are coming. This is not about efficiency. This is about survival. Now, here is the paradox. After COVID, the Bank of Canada expanded dramatically. In 2019, they had roughly 1,800 employees. By 2023, that number swelled to 2,350. They were hiring, they were growing, they were managing the greatest monetary experiment in modern history: quantitative easing, emergency liquidity, pandemic stimulus. The central bank was the engine of the entire economic response. And now they are shrinking, contracting, preparing for something entirely different. This leads us to a question most people never ask. What happens when the era of unlimited stimulus ends? Because that is what this signals. The transition from managing growth to managing decline. The shift from expansion to austerity, the pivot from liquidity abundance to liquidity scarcity. And friends, that pivot is happening right now in real time inside the institutions that control the financial system itself. Let me take you back to understand how we got here, because this story does not start with a budget memo in 2025. It starts decades ago with decisions that were made when most people were not paying attention. After the 2008 financial crisis, central banks around the world discovered a new tool: quantitative easing. The Federal Reserve began buying bonds to inject liquidity into the system. The Bank of Canada followed. The European Central Bank followed. The Bank of Japan had been doing it since the 1990s. This was supposed to be temporary, emergency measures, a bridge to recovery, but the bridge never ended. It became the road itself. By 2020, when COVID struck, central banks were ready. They had the playbook: print money, buy assets, suppress interest rates to zero, flood the system with liquidity, and it worked in a sense. Markets soared. Housing prices exploded. Governments spent trillions without consequence. Debt became irrelevant because the central bank could always buy it. This was the era of free money, the age of no consequences, and everyone got used to it. But there was a cost, a hidden cost that nobody wanted to talk about: inflation. The Bank of Canada's mandate is simple: keep inflation low and stable. Promote financial system stability, issue currency, that is it. But when you create trillions of dollars out of thin air, inflation does not stay hidden forever. By 2021, prices began to rise. By 2022, inflation hit levels not seen in 40 years. And suddenly, the central banks had a problem. They could not keep printing. They had to tighten. They had to raise rates. They had to unwind the very system they had built. And that brings us to today, because raising rates is not just a technical policy adjustment, it has consequences, real consequences. When rates rise, debt becomes expensive. Governments that borrowed for free now face crushing interest payments. Canada's federal debt servicing costs have exploded, billions more every year just to pay interest. And when the government is under fiscal pressure, it looks for savings. It looks to cut. And that includes the central bank itself. Here is what most people miss. The Bank of Canada is a crown corporation. It sets monetary policy independently, but it does not operate in a vacuum. Its budget is scrutinized. Its costs are monitored. And when the government is slashing 40,000 jobs across the public sector, the central bank is expected to participate. This is not about economic forecasting. This is about optics, about showing restraint, about proving that even the money printers are tightening their belts. But there is a deeper truth here, and this is what I call the big secret of the entire system. Central banks expanded during the crisis, not because they needed more economists or more analysts. They expanded because managing unlimited stimulus is labor-intensive. Monitoring markets, coordinating with governments, running emergency lending programs, processing bond purchases, all of that requires people, lots of people. But now that the stimulus era is ending, those people are no longer needed. The infrastructure of intervention is being dismantled, and that tells you everything about what comes next. Think about it this way. When a corporation lays off 10% of its workforce, what is it really saying? It is saying demand is falling, revenue is shrinking, the future is uncertain. The same logic applies here. When a central bank cuts staff, it is signaling that the era of aggressive intervention is over. They are preparing for a prolonged period of restraint, a world where liquidity is scarce, where bailouts are harder to justify, where the old playbook no longer works. And friends, if the central bank is preparing for that world, you should be too. Now, let me be clear about what this means in practical terms. The Bank of Canada is not just cutting jobs. It is cutting capacity, analytical capacity, forecasting capacity, the ability to monitor and respond to economic shocks. When you lose 225 employees, you lose institutional knowledge, you lose expertise, you lose the ability to react quickly when the next crisis hits. And make no mistake, there will be a next crisis. There always is. But this time, the central bank will be operating with a skeleton crew, leaner, weaker, less capable of responding. And here is the kicker. This is not unique to Canada. Central banks around the world are facing the same pressures. The Federal Reserve is under political scrutiny. The European Central Bank is dealing with fiscal crises across multiple member states. The Bank of England is navigating post-Brexit economic instability. Everyone is under pressure. Everyone is cutting. Everyone is preparing for a world where the old tools no longer work. This is a global phenomenon, a synchronized retreat from the era of easy money. So why does this matter to you? Because the central bank is the foundation of the entire financial system. It is the linchpin. When the foundation starts to crack, everything built on top of it becomes unstable. Your savings, your investments, your retirement, your home, all of it rests on the assumption that the central bank can and will intervene when things go wrong. But what happens when the central bank itself is shrinking, when its capacity to act is diminished, when the cavalry is no longer coming? That is the question we need to ask, and the answer is uncomfortable because it means we are entering a new era, an era where the safety net is thinner, where bailouts are less certain, where the illusion of stability is finally being exposed for what it always was, an illusion. Now, before we go further, I want to address something directly. Some of you might be thinking, this is just government austerity. This is politics, not economics. And you would be partially right. But here is the thing. Austerity is a choice, and the choice to cut the central bank's workforce is a signal that the government is no longer prioritizing monetary intervention, a signal that fiscal discipline is taking precedence over financial stability. And that shift, friends, is a tectonic shift. It changes everything. Let me give you a concrete example. The Parliamentary Budget Officer in Canada released a report warning that without spending controls, staff costs across the federal government could rise by billions more by 2029. The government looked at that number and decided to act aggressively. They are targeting 40,000 jobs. They are demanding 7.5 to 15% budget cuts from every department and Crown corporation. This is not a suggestion. This is a mandate. And the Bank of Canada, despite its independence, is complying because it has no choice. But here is what the report did not say. It did not say what happens when you cut capacity during a period of economic uncertainty. It did not say what happens when the next recession hits and the central bank has fewer people to analyze data, forecast trends, and coordinate responses. It did not say what happens when the scaffolding of the financial system is weakened, just as the stresses on that system are increasing. And that, friends, is the real risk, not the cuts themselves, but the timing of the cuts, because we are not cutting fat during good times. We are cutting muscle during a period of mounting fragility. Now, let me show you what is actually happening beneath the surface, because the Bank of Canada job cuts are not happening in isolation. They are part of a pattern that reveals the true state of the system. First, look at the numbers. Between 2019 and 2023, the Bank of Canada grew by nearly 30%, from 1,800 employees to 2,350. That is 550 new hires in 4 years. And now they are cutting 225. But here is what matters. They are not cutting back to 2019 levels. They are cutting from an already expanded base, which means they are permanently maintaining a workforce larger than pre-COVID levels. Why? Because the workload has permanently changed. The complexity has permanently increased. The demands on central banks have fundamentally shifted. And even with the cuts, they need more people than they did before the pandemic. This tells you something critical. The financial system has become more fragile, not less fragile, more complex, not simpler, more dependent on intervention, not less dependent. And the central bank knows it. They are cutting because they have to, but they are maintaining a larger workforce because they need to. That contradiction is everything. Now, let me connect this to the broader Canadian fiscal picture. The government is projecting 40,000 public service job losses by the end of 2028. That is 10% of the federal workforce. Gone, eliminated, vanishing in real time. Federal unions are screaming that this will undermine public services and institutional capacity, and they are right, because you cannot cut 10% of your workforce without losing critical functions. You cannot eliminate 40,000 positions without creating gaps, without breaking systems, without reducing the government's ability to serve its people. But here is the uncomfortable truth. The government does not care, or rather, it cares more about fiscal optics than operational capacity, because Canada, like every other Western nation, is facing a debt wall. Servicing costs are exploding, deficits are structural, and the political pressure to do something is overwhelming. So they are doing something. They are cutting, slashing, reducing, and the Bank of Canada is being swept up in that wave, whether it wants to be or not. Let me give you the mechanism. The government sets targets, 7.5 to 15% operational budget reductions. Every department gets the same directive. Find savings, cut costs, reduce headcount. The Bank of Canada, as a Crown corporation, is technically independent, But practically, it operates under government scrutiny. Its budget is reviewed, its expenditures are questioned, and when the entire public sector is cutting, the central bank cannot be seen as immune. So it complies. It offers early retirement packages. It freezes vacant positions. It eliminates non-salary budgets. And when that is not enough, it cuts jobs. Now, here is where it gets interesting. Central banks do not typically reduce staff for economic reasons. They reduce staff for operational or fiscal reasons, meaning they are not cutting because the economy is improving. They are cutting because their budget is under pressure. And that distinction matters because it tells you that this is not about optimizing performance. This is about surviving political scrutiny. Think about what that means. The institution responsible for managing monetary policy, for controlling inflation, for ensuring financial stability. That institution is now making staffing decisions based on political pressure, not economic necessity. The tail is wagging the dog. And friends, when the central bank starts operating like a regular government department, constrained by the same fiscal pressures as everyone else, the illusion of independence begins to crumble. Let me take you deeper. The Bank of Canada's mandate includes three things: keep inflation low and stable, promote financial system stability, issue currency. That is it. Everything they do flows from those three mandates. But here is the catch. To fulfill those mandates, they need resources. They need people who can analyze data, people who can forecast trends, people who can monitor markets, people who can coordinate with international counterparts. And when you cut 10% of your workforce, you are inevitably cutting into that capacity. Now, the Bank of Canada will tell you that the cuts are being made strategically, that they are eliminating redundancies, that they are focusing on core functions. And maybe that is true, but redundancy exists for a reason. Backup capacity exists for a reason. When a crisis hits, you need all hands on deck. You need analysts working around the clock. You need coordination across departments. You need the ability to move fast and respond decisively. And you cannot do that with a skeleton crew. Here is a historical parallel. In 2008, when the financial crisis hit, central banks around the world scrambled to respond. They created emergency lending facilities. They coordinated swap lines. They bought unprecedented amounts of assets. And they did it with fully staffed teams, experts who had been monitoring the system for years, people who understood the plumbing, the mechanics, the risks. Now imagine that crisis happening with 10% fewer people, with key positions eliminated, with institutional knowledge lost. The response would be slower, less effective, more prone to error. And friends, the next crisis will not wait for the central bank to rebuild its capacity. Now, let me show you the contagion, because this is not just about Canada. This is about a global shift, a synchronized retreat from the era of unlimited intervention. Look at the Federal Reserve. Political pressure is mounting. Demands for transparency, demands for accountability, demands to justify every dollar spent. The Fed is not cutting staff yet, but the scrutiny is increasing. The tolerance for aggressive intervention is declining. The window for action is narrowing. Look at the European Central Bank. Fiscal crises in Italy, debt concerns in France, political instability in Germany. The ECB is trying to hold together a monetary union that is fracturing along fiscal lines. And it is doing so with limited tools and shrinking political support. Look at the Bank of England, post-Brexit economic instability, inflation above target, political turmoil. The BOE is navigating a minefield with no clear path forward. Everywhere you look, central banks are under pressure. Everywhere you look, the old playbook is failing. Everywhere you look, the scaffolding is weakening. And the Bank of Canada job cuts are just the latest symptom of a system-wide problem. The era of central bank omnipotence is over. The era of consequences has begun. Now, let me address the elephant in the room. Some of you are thinking, but central banks can print money. They can always hire people back if they need to. And technically, that is true. But practically, hiring takes time. Training takes time. Building institutional knowledge takes time. You cannot flip a switch and recreate a workforce. You cannot replace years of experience with a job posting. And when the next crisis hits, there will be no time. The central bank will have to respond with whoever is left. And that, friends, is a terrifying prospect. Here is another angle. The Bank of Canada is cutting staff at the same time it is trying to manage one of the most complex monetary transitions in history. They are unwinding quantitative easing. They are normalizing interest rates. They are reducing their balance sheet. All of this requires careful calibration, precise execution, constant monitoring, and they are doing it with fewer people, less capacity, thinner margins for error. Does that sound like a recipe for success, or does it sound like a recipe for disaster? Let me give you a concrete example of what can go wrong. In 2022, the Bank of England faced a bond market crisis. Pension funds were on the brink of collapse. Yields were spiking. Margin calls were cascading. The BOE had to intervene with emergency bond purchases. They had to reverse course on their quantitative tightening plans. They had to act decisively and quickly, and they did it with a fully staffed team. Now imagine that same crisis happening at the Bank of Canada with 225 fewer employees. How fast could they mobilize? How effectively could they coordinate? How confidently could they act? The answer is unclear, and that uncertainty is a risk in itself. Now, here is where the pieces start to connect. The Bank of Canada is cutting staff. The federal government is cutting 40,000 jobs. Fiscal austerity is becoming the dominant theme. And all of this is happening while debt levels remain historically high, while interest payments are exploding, while economic growth is slowing. This is not a plan for prosperity. This is a plan for managed decline. And the central bank is being forced to participate in that decline, whether it makes sense or not. Let me show you the mathematical reality. Canada's federal debt is enormous. Servicing costs are rising exponentially. The parliamentary budget officer warned that without controls, personnel costs alone could rise by billions more by 2029. The government looked at that trajectory and panicked because they know the truth. They know that debt servicing will eventually consume the entire budget, that interest payments will crowd out everything else, that the fiscal position is unsustainable. And so they are cutting desperately, indiscriminately, hoping that austerity will buy them time. But here is the flaw in that logic. Austerity during a period of economic weakness does not solve the problem. It makes it worse, because when you cut government spending, you reduce aggregate demand. When you reduce aggregate demand, growth slows. When growth slows, tax revenues fall. When tax revenues fall, deficits widen. And when deficits widen, the debt problem gets worse, not better. This is the austerity trap. And Canada is walking straight into it. And the Bank of Canada is caught in the middle. They cannot say publicly that austerity is a mistake. They cannot criticize the government's fiscal policy, but they can send signals. And the signal they are sending is clear. They are cutting capacity, reducing their ability to intervene, preparing for a world where monetary policy is constrained, where the tools are limited, where the cavalry is not coming. And friends, if you are paying attention, that signal should terrify you. Now, let me connect this to something most people never think about. What happens to the people who are being let go? The 225 employees at the Bank of Canada. Where do they go? What do they do? Some will retire early. Some will find jobs in the private sector, some will leave the country, but all of them will take their knowledge with them, their expertise, their understanding of how the system works. And that knowledge is irreplaceable. You cannot learn how to manage a financial crisis from a textbook. You learn it by living through one, by making decisions under pressure, by seeing what works and what fails. And when you lose that institutional memory, you lose something precious, something that cannot be recovered. This is happening across the entire public sector. 40,000 jobs disappearing, thousands of experienced public servants leaving, taking decades of knowledge with them. And the government thinks this is savings, but it is not savings. It is destruction of capacity. It is the hollowing out of institutions. It is the weakening of the very structures that hold society together. And when the next shock comes, when the next crisis hits, Canada will be less prepared, less capable, less resilient. And that, friends, is the real cost of austerity. Now, let me show you what this means for you, because this is not just an academic discussion about central bank staffing. This is about the erosion of the foundation beneath your feet. When the Bank of Canada cuts 10% of its workforce, it is not just cutting jobs, it is cutting its ability to protect you, to stabilize markets when they panic, to provide liquidity when credit freezes, to act as the lender of last resort when the banking system seizes up. And friends, that protection is what allowed you to sleep at night for the last 15 years. The knowledge that no matter how bad things got, the central bank would step in. But what happens when the central bank is too small, too constrained, too politically pressured to act? Let me paint you the picture. The next financial crisis begins. Maybe it is a real estate collapse. Maybe it is a sovereign debt crisis. Maybe it is a derivatives blow-up. Whatever the trigger, markets start to unwind. Credit freezes. Businesses cannot get loans. Banks stop lending to each other. Panic spreads, and everyone looks to the Bank of Canada, waiting for the announcement, waiting for the intervention, waiting for the cavalry. But the cavalry has been cut by 10%. The analysts who would normally be monitoring overnight lending markets, some of them are gone. The specialists who would coordinate emergency facilities, positions eliminated. The economists who would model the crisis scenarios, early retirement, and the remaining staff, they are overwhelmed, overworked, trying to do the job of 2,350 people with only 2,125. And while they scramble, while they try to catch up, the crisis deepens, spreads, metastasizes. This is not speculation. This is logic. This is what happens when you weaken critical infrastructure during a period of mounting risk. And the risk, friends, is mounting everywhere you look. Let me show you the convergence, because we are not facing one problem. We are facing three distinct forces hitting simultaneously. First, there is the structural break in global central banking. The era of unlimited stimulus is over. Interest rates are rising, balance sheets are shrinking, liquidity is draining from the system. Central banks that spent 15 years expanding are now contracting, and they are doing it at the same time. Synchronized tightening, coordinated withdrawal, the opposite of what happened in 2008. Back then, everyone was expanding together. Now everyone is contracting together. And that creates a liquidity vacuum, a void where credit used to be. And into that void, assets begin to fall. Second, there is the domestic fiscal crisis. Canada, like every Western nation, is drowning in debt. The pandemic spending was unprecedented, the deficits were historic, and now the bill is coming due. Interest payments are exploding. The government is being forced to cut, to slash, to reduce. And those cuts are not just hitting the central bank. They are hitting infrastructure, healthcare, education, everything. The entire public sector is shrinking. And when the public sector shrinks, economic growth slows. Because government spending is a component of GDP. When you reduce it by 10%, you reduce growth. And when growth slows, tax revenues fall, and the debt spiral accelerates. Third, there is the psychological shift. The transition from expansion to austerity, from abundance to scarcity, from confidence to fear. Human beings are hardwired to believe tomorrow will look like yesterday. This is called normalcy bias. It is a survival mechanism, but it is also a trap because when the environment changes, when the rules shift, normalcy bias keeps you anchored to the old world. It prevents you from seeing the new reality. And right now, the new reality is this: the safety nets are being removed, the backstops are being eliminated, the protections you took for granted are vanishing in real time. And most people are not noticing. They are going about their lives, checking their retirement accounts, watching their home values, assuming that the system will hold, that the central bank will intervene, that the government will step in. But what if it cannot? What if the capacity has been cut? What if the tools no longer work? What if the architecture of safety is collapsing beneath them while they sleep? This is the money illusion, the belief that numbers on a screen represent real wealth, that a balance in a retirement account is the same as owning something tangible. But it is not. A retirement account is a claim on future dollars. A stock portfolio is a claim on future earnings. A bond is a claim on future government payments. Everything is a claim. Everything is paper. Everything is dependent on the system functioning, on institutions maintaining capacity, on central banks being able to intervene. And when those conditions break down, the claims evaporate, the paper burns, and you are left holding nothing. Now, let me give you the choice, the binary decision that will define your financial future. Do you own assets or claims on assets? Gold is an asset. Land is an asset. Silver is an asset. Physical things that exist, regardless of whether the Bank of Canada has 2,350 employees or 2,125. Tangible things that do not depend on institutional capacity or central bank intervention or government solvency. Stocks are claims. Bonds are claims, ETFs are claims, mutual funds are claims, retirement accounts are claims. Everything in the traditional financial system is a claim on someone else's promise. And when the system weakens, when capacity shrinks, when institutions fail, those promises become worthless. This is not about market timing. This is not about predicting the next crash. This is about understanding the transition we are living through, from illusion to reality, from paper wealth to hard assets, from claims to ownership. The Bank of Canada job cuts are a symptom, a signal, a warning that the era of unlimited institutional support is ending, that the scaffolding is being dismantled, that the foundation is cracking. And if you are still building your financial life on that foundation, you are building on sand. Let me be absolutely clear about what I am saying. I am not telling you to panic. I am not telling you to sell everything tomorrow. I am telling you to recognize the structural shift that is happening, to understand that the rules are changing, that the institutions you relied on are weakening, that the capacity to intervene is shrinking, and to position yourself accordingly. Gold and silver are not investments in the traditional sense. They are insurance. They are stepping out of the line of fire. They are owning something real in a world of increasingly fragile claims. When the Bank of Canada has fewer people to manage the next crisis, when the federal government has gutted 40,000 positions, when the capacity to respond is diminished, you want to own things that do not depend on that capacity. Things that hold value regardless of institutional function, things that survive when paper burns. Now, some of you are thinking, but gold does not pay dividends. It does not generate income. It just sits there. And you are right, but that is the point. Gold sits there. It does not require a functioning banking system. It does not require government solvency. It does not require central bank intervention. It just exists. And in a world where all of those things are becoming uncertain, existence is enough. Let me show you the historical pattern. Governments and central banks expand during crises. They hire, they grow, they intervene. And then when the crisis passes, they contract, they cut, they reduce. This is normal. But here is what is different this time. They are contracting before the crisis has passed, before the system has stabilized, before the debt has been resolved. They are cutting capacity while the risks are still elevated, while the fragility is still extreme, while the next shock is still coming. And that tells you everything. It tells you that they know something, that they see something, that they are preparing for a world where intervention is no longer possible, where the tools no longer work, where the only option is managed decline. And if that is the world they are preparing for, you should be preparing for it too. Now, let me address the final psychological barrier, the belief that they will not let the system fail, that governments will step in, that central banks will print money, that somehow, some way, everything will be fine. This belief is powerful, it is comforting, and it is dangerous because it assumes that they have the capacity to act, that they have the tools, that they have the political will. But what if they do not? What if the Bank of Canada has been cut too deeply? What if the government is too constrained by debt? What if the political environment has shifted so dramatically that intervention is no longer acceptable? These are not hypothetical questions. These are the questions that the Bank of Canada is asking itself right now as it decides which 225 employees to let go. These are the questions that the federal government is asking as it plans to eliminate 40,000 jobs. These are the questions that should keep you up at night because the answer is becoming clear. They are not going to save you. They are cutting capacity. They are reducing their ability to intervene. They are signaling as loudly as they can without saying it explicitly that you are on your own. And if you are paying attention, if you are listening to the signal instead of the noise, you will understand what needs to be done. History favors the prepared. It favors those who see the structural shifts before they become obvious, those who recognize the fault lines before they rupture, those who move from claims to assets before the claims evaporate. The Bank of Canada has just told you that the foundation is weakening, that the capacity to protect you is shrinking, that the era of unlimited support is over. The question is not whether you believe me. The question is whether you believe them, whether you trust the signal they are sending, whether you understand what it means when the people who print the money start firing their own staff to save money. The window for preparation is closing. The transition from illusion to reality is accelerating. The choice between paper and hard assets is becoming starker every day. And friends, the time to decide is now, not tomorrow, not next month. Not when the next crisis hits and the Bank of Canada is scrambling with 225 fewer employees to contain it. Now, because when the liquidity tide goes out, we are about to find out who has been swimming naked, and I do not want that to be you.